Netflix just did something brilliant that nobody's talking about. While everyone's watching the headlines, they made a move that could reshape the entire streaming industry, and it reveals exactly how they're thinking about the future of entertainment. Let me show you what they just pulled off. So, Netflix reported earnings yesterday, and yeah, they beat expectations again. $12 billion in revenue, 325 million members. Standard Netflix stuff, right? But here's where it gets interesting. Their growth is slowing. 12 to 14% expected growth this year. That's down from 16% last year. And when you're a giant company trying to stay relevant, slower growth means you've got to make strategic moves. This is where it gets game-changing. Netflix is bidding $72 billion for Warner Bros. Discovery's film and streaming assets. Now, Paramount's making a higher bid, $108 billion. But here's the economic genius most people missed. Netflix is being selective. They're not bidding on cable and news assets, just the entertainment IP and streaming infrastructure. Why? Because they did their homework. They know exactly what they need and what they don't. Paramount's paying for everything. Netflix is paying only for what generates returns. That's the difference between a company that owns its market versus one that's desperate to compete. Netflix is surgical. Paramount is scrambling. But here's the real economic signal. Netflix is pausing stock buybacks. You know what that usually means? They're about to spend aggressively on something. And sure enough, their CFO basically confirmed it. Content spending is going up significantly in the first half of 2026. They're taking money that used to go to shareholders and investing it directly into original content. That's a statement about where they think value is going. With that Warner Bros.' catalog, they can cut down on licensing costs and control their own IP. They own the assets, they own the profits. Meanwhile, they're saying there's no price increase coming. They're betting on volume and engagement, not squeezing subscribers. The stock dropped 5% in pre-market trading. Investors got nervous about the WBD deal because of acquisition risk, regulatory approval, integration costs, uncertainty. That's normal. But economically, this is Netflix making a power move. They're shifting from a rental model to an ownership model. They're betting that controlling content is more valuable than extracting maximum revenue per subscriber right now. It's a long-term play. And look at their guidance. They're expecting 15.3% revenue growth next quarter alone. That beats expectations. So the market's being short-sighted. Netflix knows something investors haven't priced in yet. This is actually textbook economics. When you're in a saturated market competing on quality, you stop distributing excess cash to shareholders and you invest in competitive advantages. Content is Netflix's moat. If they own Warner Bros. Content, they don't have to negotiate with competitors. They control the supply. Paramount's doing the opposite. They're trying to buy everything because they're playing defense. Netflix is playing offense. One's reacting to competition. The other's reshaping the industry. That's why this deal matters. It's not about money, it's about market structure. The real question isn't whether Netflix wins. It's how many competitors survive when they do. That's the economics nobody's discussing yet.